Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications.
Hey everyone, welcome to Long Run Lab, the show that takes a deep dive into serious long-term investing. I'm Up from Joy Up Invest. Today, we're talking about DCA, or dollar cost averaging, a concept many people think they've mastered but might actually be doing all wrong. I've met so many investors who've done DCA incorrectly and ended up losing money instead of gaining it. So, before we get started, let's get a clear definition of what DCA is. Simply put, DCA is investing a fixed amount of money at regular intervals, regardless of whether the asset's price goes up or down. For example, let's say we decide to invest $100 every month in an S&P 500 fund. We'd buy every single month, whether the share price is high or low. A lot of people think that's all there is to it, but actually, that's just the first step. Part 1. The problem with superficial DCA. So why do I say so many people are doing DCA wrong? Because they believe DCA is a magic bullet that solves everything. They think they can buy just about any stock or asset, keep buying it bit by bit, and they'll get rich automatically. Let me give you a real-life example. An investor came to me for advice. He had been doing DCA on a stock called NOK, or Nokia, for 5 years, investing $500 a month. He thought a famous company like Nokia would surely recover. But the result? He lost almost 60% of his investment because Nokia was a declining company, not a growing one. This is the key point I want to emphasize. DCA is not a magic spell that turns bad assets into gold. Doing DCA with an asset whose value is constantly dropping is like digging a hole deeper and deeper, not climbing a mountain. Part 2. The heart of DCA that actually works. In reality, DCA works best when we use it with assets that have two crucial qualities. The first quality is a long-term growth trend. Imagine we're climbing a mountain that's getting higher and higher. Even if there are a few dips along the way, overall, we're heading in an upward direction. The second quality is volatility along the way. This might sound strange, right? Many people think volatility is a bad thing, but for DCA, volatility is your friend. That's because when the price drops, you get to buy more shares for the same amount of money. When the price goes up, you get fewer shares, but the value of your portfolio increases. Let's take an example of investing in Apple, AAPL. If you had done DCA on Apple over the last 10 years, even through various crises like the trade war, COVID-19, or high inflation, you would have gotten excellent returns. Why? Because Apple is a company with strong fundamentals, products people want, and consistent revenue growth. Part 3. Picking the right asset. So how do we know which asset is right for DCA? I've got a couple of easy techniques to share. The first way is called top-down analysis. This means looking at the big picture first. Start by asking yourself, where will this industry be in 10 years? For example, the tech industry, AI, or clean energy will likely continue to grow for a long time, but industries like coal or newspapers might not be the best choice. The second way is bottom-up analysis, which means diving deep into a specific company. Ask, what are this company's strengths? Does it have a moat? A moat is like a castle's defensive ditch. The deeper the moat, the harder it is for competitors to steal market share. Great examples of a moat are Apple's incredibly strong brand loyalty. People who use an iPhone rarely switch to Android, or Google's search engine, which dominates almost 90% of the market worldwide. You also need to look at the financial numbers. I check things like gross profit margin, how much money a company makes from its products before other costs, net profit, the final profit after all costs, ROE, return on equity, which measures how well a company uses its shareholders' money to generate profits, and the debt-to-equity ratio to see if the company has too much debt. Part 4. Portfolio rebalancing, the step many forget. This is super important. Many people do DCA and then just forget about their portfolio. This is a huge mistake. Portfolio rebalancing is the process of adjusting the allocation of assets in your portfolio to bring them back to your original target percentages. For example, let's say you started with 70% stocks and 30% bonds. After 2 years, your stocks did so well that they're now 85% of your portfolio and bonds are only 15%.
This means that your portfolio's risk level has gone up without you even realizing it. Rebalancing means you'd sell some of your stocks and buy more bonds to get back to that 70-30 ratio. It might feel like you're selling something that's going up, but in reality, you're taking profits in a systematic way. You can rebalance in two ways: time-based, like every 6 or 12 months, or threshold-based, like when the allocation shifts by more than 10% from your target.
Part 5. An interesting case study. I want to share an interesting story with you. I once simulated a DCA investment comparing Apple and Nokia over a 10-year period. If we had invested $300 a month in Apple, we'd see that during sharp price drops, like during the COVID-19 pandemic in 2020, we would have bought more shares. When the price recovered, the value of our portfolio grew impressively. But if we had invested the same amount in Nokia, a company in permanent decline, we would have bought more shares when the price dropped. However, because Nokia's business had major problems, the share price continued to fall. In the end, we would have suffered a huge loss. This is exactly why asset selection is so critical for DCA. Part 6. Building the right DCA portfolio. So how do we build the right DCA portfolio? I've got a few steps to share. Step 1. Define your goals clearly. Do you want to retire at 60 or save for your child's education in 15 years? A clear goal helps you plan correctly. Step 2. Assess your risk tolerance. If you are 25 and have 30-40 years to invest, you can handle more risk than someone who is 55 and retiring in 10 years. Generally, I divide risk levels into 3 categories. Conservative, for those nearing retirement with about 15 to 35% in stocks and the rest in bonds or savings. Balanced, for working adults with 30 to 60% in stocks and the rest in bonds. And growth, for younger individuals with a long time horizon who can put 50 to 80% in stocks and the rest in bonds to buffer volatility.
Part 7. Fundamental analysis techniques. When selecting assets for DCA, I look at 2 main angles. The first is qualitative factors. I ask myself, will people still need this business in 10 years? Does the company have a strong moat that's hard for competitors to beat? Is the management team trustworthy? Is the revenue growing consistently? The second is quantitative factors, which are the numbers in the financial statements. For example, a gross profit margin of 40 to 50% indicates a strong bargaining position, allowing the company to set high prices for its products. A consistently high ROE, return on equity, shows that management is great at using shareholders' money to generate profits. And a reasonable debt-to-equity ratio tells me the company isn't burdened by too much debt. Part 8. The importance of discipline in investing. Another crucial thing is discipline. I've met many investors who start DCA well, but when the market goes down, they start to hesitate, thinking, maybe I'll skip this month, the price might go down even more. Or when the market skyrockets, they want to invest more than usual. This is a big trap. DCA works best when you do it consistently, no matter what the market is doing. If you start letting emotions guide your decisions, your DCA strategy turns into a market timing strategy, which is incredibly difficult to succeed at. I recommend setting up an automatic investment plan through your bank or brokerage. This way, money is automatically transferred to buy your fund or stock every month, and you don't have to think about it. Part 9. An effective rebalancing strategy. Let's continue our talk about rebalancing. Many people might wonder why it's necessary. The reason is that over time, the assets that have grown well will make up a larger proportion of your portfolio, unknowingly increasing your risk. For example, you might start with 60% stocks and 40% bonds, but after 5 years, your stocks have done so well they now account for 80% of your portfolio, with bonds making up only 20%. This means your portfolio is riskier than you intended. Rebalancing helps you sell high and buy low systematically. It's a way of taking profits from the assets that have risen a lot and using that money to buy assets that haven't gone up as much. I recommend rebalancing every 6 to 12 months or when the allocation shifts by more than 10% from your goal. Part 10, Mistakes to Avoid. I want to share some common mistakes I see with DCA. The first mistake is choosing the wrong asset. As I mentioned, DCA on an asset in permanent decline won't work. The second is not rebalancing, which leads to a portfolio that's either too risky or has low returns. The third mistake is a lack of discipline, stopping DCA when the market is down or investing too much when it's up. The fourth mistake is having too short a time horizon. DCA is a long-term strategy for at least 5 to 10 years. If you're expecting results in just 1 or 2 years, you'll likely be disappointed. Part 11, Summary. In the end, the correct way to do DCA is not just about buying in fixed installments. It's a complete investment system made of 3 key pillars that will help you build a solid foundation and increase your chances of achieving your financial goals. The first pillar is fundamental analysis. Before you start, you should take the time to study and analyze the fundamentals of the asset you're interested in, making sure it has a long-term growth trend that fits your goals. The second is consistent portfolio rebalancing. Don't let your portfolio drift with the market. Have a clear plan to adjust your asset allocation. And the final pillar is discipline. Stick to your plan no matter what the market is doing and avoid making emotional decisions, because discipline is the single most important factor for long-term success. And that concludes this month's Long Run Lab podcast. I hope you all found our discussion useful. Join us again next time. Don't forget to like, share, subscribe, and hit the notification bell for Joy Up Invest so you won't miss out on great content like this every day. See you next time.